In today's video, we'll be presenting a trading strategy for trading the Forex major pairs. It'll be a strategy that is quite simple in concept, and it'll use daily bar frequency, and the currency pairs that it's going to be based off are the euro, the yen, British pound, Aussie dollar, and Canadian dollar. And these are all versus the US dollar. And the system will consist of two submodels, which are trend and counter trend. Now, long-term trend following systems, they don't really work very well on daily bars in the Forex markets. Here I did an example of two of these long-term trend following systems applied to the portfolio of those 5 Forex pairs. So the first one here on the left is the 50-day, 200-day moving average system. And that's also known as the golden cross system. And you can see the equity curve of the backtest. This is a backtest going from 1999 to 2024. And it's extremely rough. And it's got a Sharpe ratio of only 0.14. And here on the right side, we've got an 80-day Bollinger Band system applied to the same portfolio of 5 Forex pairs, and equally as rough, and it has a Sharpe ratio of only 0.12. What if we trade extremely short term? What we're going to do is we take a position in these currencies based on a 50-day price breakout and hold for just 1 day after that breakout happens. Here's an example using the USD JPY. So here the green arrow shows that there has been a 50-day breakout. In other words, the close price here is the highest close of the past 50 days. So what do you do then? You take a long position. And here's an example of the day after the 50-day upward breakout. It's a profitable day. And here is an example of one trade after a 50-day breakout on the downside. So this close here was the lowest close of the 50 days. And so you take a short position here and you have a profitable down day. And here's the long-term back test of using that simple rule going back to 1999. And this is applied to the portfolio of 5 major FX pairs. And here's the equity curve. It's got a Sharpe ratio of 0.19. It is better than those 2 long-term trend following systems I showed a couple of slides ago, but it's not quite usable as a standalone strategy. It's still looking a little rough. So what we want to add in is a counter trend system using a similar rule, but the mirror image. So what if you take a reversal position based on a 10-day breakout and hold for 1 day following that breakout? Here's an example with GBP USD. So here the green arrow shows you that this close price was the lowest close of the past 10 days. So you take a long position the following day. And here's the reversal, which made a profit. And here's the example where you go short. So here, the close is the highest close of the past 10 days. So you go short. And the following day, you had a nice reversal happening right here. And here's the equity curve of that counter trend strategy backtested to 1999. That one has a Sharpe ratio of 0.24. And its correlation with the 50-day trend breakout is negative 0.7. So it's almost perfectly negatively correlated. So let's see what happens when you combine the two. So first of all, here's the rolling correlation graph of the trend and the counter trend breakout systems. It's got an average correlation of negative 0.7, and it oscillates around that number. The highest correlation, rolling correlation, was negative 0.3, and the lowest one was negative 0.95 or so. And here are the equity curves of blending those two systems 50% each on the 5 different currency pairs. So here's Aussie dollar USD, and that's 50% trend and 50% counter trend. Same here for euro, Canadian yen, British pound. And here are the trend and counter trend equity curves aggregated for the 5 currency pairs. So the orange equity curve here is the counter trend system applied to all 5 currency pairs. And the blue line is the trend system applied to all 5 currency pairs. So you see they're almost exact mirror images of each other. And when you combine 2 systems that are so negatively correlated, like a mirror image, and they both have slight upward bias, then the combination will have a highly synergistic effect where the Sharpe ratio has a very significant pickup. And so here it is, the trend system had a Sharpe of 0.19, and the counter trend system had a Sharpe of 0.24. And when you do a 50-50 blend, this is what you get. It's a much better equity curve than either of the 2 components, and the Sharpe ratio goes up to 0.55. So, you can combine, this goes in system design in general. You can have some pretty crude systems with low Sharpe ratios, but when you combine those, you'll get pretty surprising results. And that's what a lot of system traders do. They don't have a one magical system that's really high Sharpe ratio. They often use a combination of many component systems, each that are conceptually very basic, and they might have low Sharpe ratios when you look at each one by itself. And what about leverage? Forex trading, when you do it unleveraged trading, unlevered trading, it generally tends to have very low returns. So leverage is an intrinsic part of what is needed for Forex. So here's the unleveraged return year by year, going from 1999 to 2024. It's got an average annual return of 0.7%. When you do 5x leverage, it's a 3.4% return. At 10x, you've got 6.8%, and at 20x, you've got a 13.6% return. What I've done is I've created a spreadsheet containing this backtested system on the 5 FX pairs, and I've made it available on my website. If you want to download it, feel free. You can play with the leverage number and various parameters and see if you can improve upon this basic backtest. What if we combine this Forex strategy with an equity strategy? What if we do a 50-50 blend with the golden cross plus mean reversion strategy, which trades the NASDAQ 100? And that's a strategy that I backtested in one of my other videos. I'll put a link to that one as well in the description box. So the rolling correlation between the Forex strategy and the NASDAQ 100 strategy is 0. In other words, they have nothing to do with each other, completely uncorrelated. And so they should be good candidates to combine with one another. And the hope is that it'll give a smooth equity curve with an increased Sharpe ratio. And here's what you get. So the pink line is the NASDAQ 100 strategy equity curve with the Sharpe ratio of 0.76. And the black line is the Forex strategy with a Sharpe ratio of 0.55. And when you blend them equally, this is what you get. You get a pretty nice looking equity curve, which might just be tradable as a standalone system. It's got a Sharpe ratio of 0.91. In conclusion, one can construct an effective daily bar system for trading major Forex pairs. The first edge that we found was that we're using short holding periods. It only holds for 1 day subsequent to the price breakout, either on the upside or the downside. The second edge that we found was by blending a trend and a counter trend system, we can get a much smoother result. And we also found that this Forex strategy combines well with other strategies such as an equity index strategy because of non-correlation. If you want to learn more about this system and you would like to download that backtesting spreadsheet on the 5 Forex pairs, feel free to visit my website at returnstream.com. I'm going to put a specific link to the page, to the post in the description box below. Thank you for watching.